I'm Amit Sharma, and today we are talking about risk and compliance, but trying to view it from another lens. How do we look at risk and compliance and the application of the digital identity space to driving those functions that are traditionally have been seen as fixed cost, growing back office, almost burdens to value-added assets when you think about financial services and other use cases. I have a really pretty talented and experienced crew up here that I'll turn over to for intros across the space, whether it's AML, KYC processes, whether it's providing financial empowerment tools, or just broader financial access. And so let me go down the line and let you guys introduce yourselves, and then I'll kick it off with a couple questions.
First, my name is Jose Caldera. I lead marketing and products for IdentityMind Global. IdentityMind, we actually started using the concept of digital identities about 7 years ago and tried to understand how to use digital identities for fraud prevention and for compliance, for the automation of compliance. And I'm actually quite excited to see that 7 years later, at least there is a conference that talks about the value of digital identities in this context. So it's kind of a validation of what we started a long time ago, and we had to educate the market a little bit of why that was a good idea. So it's good to see that the market as a whole is moving towards this direction. So thank you.
I'm Laura Spiekerman. I'm one of the co-founders at Alloy, which is a software platform and API to help regulated financial institutions handle their KYC and AML requirements during onboarding. And in a previous life, I was working on financial inclusion both as an investor and as an operator at a company in East Africa, and so I'm also sort of interested in the idea of sort of what identity means for getting financial services sort of beyond the distribution challenge.
How's it going, everyone? Thanks for hanging out with us today. My name is Kapoor. I'm the COO and co-founder of a startup called Curu, which stands for Your Personal Credit Guru. It's a robo-advisor for credit focused on underbanked millennials.
Hi, I'm Shailee Adinolfi, Vice President at BanQu. We provide economic identities for people, assets, and organizations on the Ethereum network. And our target market is the bottom 2 to 3 billion that are un- or underbanked in emerging markets. So similar area of financial inclusion is my background.
So let me start off with a couple of statistics, and we think about at least the formal regulated space, right? There have, through 2016, global fines have exceeded 200 billion when we think about governance, risk, compliance issues. The regulatory rules, guidance, procedures, and even laws continue to grow when you think about regulatory reporting, anti-money laundering, and bank secrecy related issues. I think some have estimated that in 2017, the estimated spend by just top-tier global banks will be somewhere on order of 60 to 100 billion in just IT spend related to governance, risk, and compliance. And if you think about the top 10% of global banks, you're looking at greater than $100 million a year just on compliance alone, right? So a lot of time and effort goes into the governance, the regulatory, and the compliance issues. And then the question becomes, one, where is it all going? Is it actually serving the purpose it needs to serve? And importantly, how do we look at risk and compliance, which are these, quote, necessities to protect financial system integrity, as actually value-added components to the rest of financial services? And whether it's the front office of a bank, whether it's looking at financial empowerment and inclusion issues, how would you look at these issues, at least from a regulatory and compliance level of due diligence that you're required to do as proactively and creatively as value added? Maybe I'd start with Jose and then move down.
Sure. So there is an aspect of how you perform compliance and the information that you collect about your clients and about how they interact with you that is necessary, not a question for the compliance perspective. However, a lot of that information can also be used to have a better user experience, for example, for your clients, to better market to your clients, and so forth. So there is actually a connection between what you can use from the compliance perspective, what you can use from the regulatory perspective, and what you can use to help better service your clients. So the more you understand, and the more you understand the connection between those two, the more you can sort of not necessarily see compliance as a cost, if you will, but also how you leverage that information and you turn that into how to boost your customer growth, your customer acquisition, and so forth. And I think that right now, most organizations, especially traditional banks, are not set up sort of to take advantage of that. They don't understand well, the infrastructures are so siloed within traditional financial institutions that information doesn't flow from one aspect to the other. I always remember back to many of our clients, and I have said the same thing to many people that I've met here, is that, when we go to a client and we always try to bring together user experience with compliance, with fraud in the same room and try to make them understand and see that the data that you need for one process actually can be leveraged for another processes. So I think once you make those connections, then you start understanding how to turn that money that you have to spend because you're regulated and you have to comply with that, how to turn that information into valuable asset such that you can have a higher customer growth.
Laura, you work to simplify and make cost-efficient onboarding AML KYC. There's clearly a need in that marketplace. How many of your clients then look at you and say, hey, how can this help the rest of my business in terms of customer acquisition, customer retention, et cetera?
Yeah, so our focus is really, it's almost the sort of the flip side of that, which is you come to us because you have a conversion problem, because you have people who you're onboarding someone to retail banking application and you're asking for information because you're required to have it. But they come to us when they say, look, I'm compliant, I'm doing everything right, but 50% of the time I'm sending people to manual review. That's not a compliance problem, it's a customer acquisition problem. And that's where we find that we can be, having more data is really helpful. And it's again, sort of not solving this compliance gnarly issue that is certainly a cost center. It's trying to be on kind of the other side of the business, which is also easier from a sales perspective as well. I mean, it's a different customer base. But I think, Jose is totally right that there's just this opportunity to actually leverage that data, not for compliance purposes necessarily, although you have to do that, but there's ways to leverage the data that are much more attractive to our customer base.
You're working proactively on financial empowerment, right? Really growing credit capability on the part of the customers that you serve. When you look at the risk and compliance side, do you see an antagonist, a burden or hill to overcome? How do you look at it from your perspective?
Well, I mean, there's two kind of sides to it. So Laura and Jose were saying, there's the data component where you can use that for effective decision making. But from a millennial entrepreneur that's grown up on innovation and disruption and taking risks, it kind of has this burden of reduced innovation and kind of reduced risk taking. So when it comes down to making decisions, it can be a bit of a hindrance. But again, there's also the other side of the necessary to collect data and then use that data for effective business decisions and moving the product and service forward.
That's very helpful. Shailee, you are in a business that is really going to the margins of those excluded and bringing them into a system so they can access credit transfer, make payments, transfers, et cetera. How do you look at the tools around AML KYC in the context of identity to just bring folks into the system?
Sure. So in many of the countries where we're working, in developing countries such as Nigeria and Indonesia, they've taken a lot of steps in the past 5 to 10 years towards more inclusive financial policies. So risk-based KYC and tiered KYC levels, and that's been really useful for us. So for example, a village chief can vouch for you if you have no identity, and you can, and if that village chief has an identity with the government, they can get you to a bank, vouch for you, and get you a low-level transaction account. We consider that a trust, as somebody that can be a part of your trust network. So someone's trust network to us as a part of this economic identity is very important, because that can be a factor in future alternative credit scoring, using some of those features. So we're really looking at those people that are trying to just pull together pieces of information about what they own, their small plot of land, the harvest that they have, their trust networks, and their mobile money payments, their M-Pesa payments, to pull that information together and use it to leverage for financial services.
Jose, you've been doing the identity work for 7 years. How has it evolved? How's the digitization of identity helped you or hurt you? And how have you had to amend your business when you think about that evolution?
So we are very biased to online world. So what I mean by that is that our views of identities have to do with the ability of users to interact with financial systems online. So our view was always kind of skewed to a concept of identity that is partially on the net, and we always look at definitions of identity that involved things that you can capture while you are online. I think there is a new, well, I wouldn't say new, but there is an additional things that you can think of. So biometrics, for example, is one of them, right? So biometrics start becoming something that is interesting to further define what an identity is from the recognition perspective and from the behavioral perspective. There are aspects that now are coming to light on specific behavioral, not necessarily from the biometric perspective, and not necessarily even from the expenditure perspective, which is a kind of a marketing way of looking at identities. But it has to do with how you interact, how, and again, my view is also skewed towards financial systems, because that's where we focus ourselves and how we support identities. And from that perspective, then the behavioral aspects of how you interact with financial systems is very important. There's something to be said about that trust aspect of it, and I think that is important, because there is a notion of how do you evaluate an identity where you have very little information about. And in these concepts of trust, and who do you trust, and how that sort of what you were saying before about the vouching, how you express that in a detailed manner, is very tricky, very interesting, but a notion of how you trust and how you validate data, it needs to be part of the model of the identity itself. So we take some of those models coming from the banking industry, right? For example, when somebody accepts a credit card, there is already a implicit validation of the usage of a credit card associated to a user, assuming that there are no chargebacks and that kind of stuff later on. But that notion of trust, it's evolving, and I think that as we put more services as part of that definition of an identity in the digital world, you're going to see more components of that trust and that validation that still is hard for both the unbanked and the underbanked. So it's evolving.
Do you think that this can be universally applied, Laura? Do you think it's something that's going to start only in the formal sector for now, or is there something that can translate to informal networks?
I think there's actually interesting models. I mean, sort of like M-Pesa, we've seen ways of doing things because we've had to outside of the formal sector that I think actually can be somewhat replicated in the formal sector. So one of the things that comes to mind is the way that now in the United States, some of us are using data from telcos, for example, right, which I think 5 years ago was a really different landscape, where we've been incredibly reliant on public records databases and credit bureaus. And now we're sort of saying there's other carriers of identity-related data out there, whether they're regulated or not, or whether they're sort of formally approved by an agency or not, they are relevant, which we've seen in the developing world. We hadn't really seen that much of until recently here. Another one I was just talking to a bank about was the use of pay TV data. So it's another sort of, for people who are outside of these formal channels, it's a great source of data. If you have cable TV and you pay your bill, it's a great way to find out whether your address is linked to that name and to that account. So I think there's actually some sort of reverse innovation stuff going on that will be important for the formal sector in the United States. And I think we've been behind, similar to the kind of M-Pesa story as usual in the US, we're behind.
Yeah, no, I think that.
Can I add to that? So I actually do, I agree. I think we're gonna start to see a lot more innovation in some of the emerging markets where you don't have the heavy regulation, and you also don't have banking, at like 80-90%, right? There are some countries that are just struggling with how do we reach, the majority of our population without this expensive bank branch infrastructure that we know of, and they're looking at the fintech solutions, and they've actually are open to the innovation. So I do think that if us in the distributed ledger space, if our dream of like this distributed economy actually comes about, not to say that banks and governments won't be there anymore, but there will be a bit of disintermediation, right? If it all works out in the way we're thinking, then I think we will start to see more informal ways of lending where, your village is your capital and your neighbor is your banker, right?
I just want to add one more thing. The interesting thing, I think, in the US is that even today, in very traditional, like even 5 years ago, if you looked at sort of how KYC was done online, you're still relying on non-government databases in some cases. And they are, they have sort of this informal stamp of approval and your ability to rely on them without getting in trouble. And it's a little bit, it feels a little like it could be, could be anything, and they just happen to have this sort of stamp of approval, and it's because there are these legacy databases and they've been around a long time, but there's no sort of approval system, and so it should be up for grabs who's able to come up with sort of the best new way to approve someone next.
Well, there are aggregators, right? I mean, you still have lists across the board, the US, the OFAC list, a number of European and Asian lists that you just by definition have to run through. Then the question becomes, how do we get the additional level of granularity when we think about compliance or risk broadly? Ab, when you think about your business, and you're not a specific bank per se, but you're reliant on systems, and you push individuals presumably to then seek additional services as a result of empowering them through by way of credit. How do you balance that, sort of those folks on the fringes versus the classic millennial that is educated enough or that you can get through the system to then be an informed participant in the financial services space?
It's funny because we'll go to like these college road shows and we'll look at all these different markets, and like you were saying, that educated millennial that kind of has a general understanding of credit or just finances in general will understand the importance of, just at the base of getting a credit card. And so what the barrier becomes is people, particularly, I'm focusing more so on the millennial end, they're scared. Like honestly, they're scared to kind of build that financial identity, start building credit in general. And the reason why is because they have no idea what they're doing. So it really starts with financial literacy and kind of informing them on what you need to do. So what we at Curu did was just a lot of inbound marketing, going to Quora, Twitter, Facebook, Instagram, anywhere that we can get direct access to people with questions, and then answering those questions and then getting them from that perspective.
Got it. I'm going to throw a bit of an antagonistic question out there, especially when we think about the fringes, right? When we talk about banked, unbanked, underbanked, there's this presupposition that coming into the formal regulated space is the end-all, be-all for the provision of financial intermediation or services, right? Is it? How does identity play in this space, especially given the evolution you guys are talking about, and the amount of transaction volume and flows that are happening person to person, governments to persons, merchants to persons, that quite frankly may just be increasing in the informal space? How do we look at risk and compliance in that perspective? Who's first?
I'll say that I think that there's certainly a number of people who have been left out. Distribution, particularly mobile distribution, was a huge boon to underbanked and unbanked. It was only the beginning though, and you saw a lot of accounts being opened and left completely empty and with no transactions. And so the next challenge, to me at least, was identity. Like there's a couple of barriers. One is there's a lot of people who weren't able to get these accounts because of lack of identity. I think you see that across the world. The other is, once you have an account, what do you do if you don't have transactions, if you don't have credit? There's this whole suite of products that you need on top of that. And I don't think we've seen sort of that next step happening. So identity is a crucial part, but so is engagement with a user. It could be as simple as, there's a company that I'm gonna blank on the name of right now that I'll try to remember, but part of what they discovered was that opening an account was somewhat useless unless you engaged with the user every single day in the markets that they were working in. That meant sending reminders to save, reminders to input what they were spending, all sorts of stuff. And so there's this sort of next level challenge that I'm not sure banks, frankly, are up for today for certain markets, for certain sectors or certain segments of the population, but it's going to be the sort of next way to actually get people who are needing to get loans or whatever it is to get there.
So I think, and I'm trying to see if I understood correctly your question, by the way, but if the issue is how do you perform risk and compliance when you are dealing with people that you know very little about, right? I think that's going back to that. One thing that we cannot forget is that 99% of clients are good, and in prefacing the service of a financial service just by saying, the likelihood of risk is too high, right? When in general, the very, very, very large majority of users are good, is already an unfair system in a way, right? So, and I think most systems, and I throw ourselves in the bunch because we are guilty of, as a fraud vendor, as a risk vendor, that to say, oh, risk everywhere, you should see risk everywhere, right? And I think in the contrary, I think that the focus is that you have to try to understand that most users are going to be good, and understand how do you take if you take that premise and then you start building systems that are able to go and try to figure out whether you are a good user before you try to be if you're a bad user. I think you can leverage things and you can base your decisions on things that you may not see today. Now the challenge obviously is how that then if you have an examiner, for example, how the examiner goes and say, well, what do you do on your customer identification program, for example, from the VSA perspective, to know that you're dealing with the right guy, that you're dealing with this? And that's when it's going to become tricky. But from the regulatory perspective, we also have to evolve into understanding that those situations require a very different concept. So the risk-based approach that you were describing before is absolutely correct. And in the US, even FinCEN has come forward and has agreed that to say you have to have a risk-based approach to when you're doing KYC, when you're doing different compliance levels. And every time that we are now working in Latin America, that concept of risk-based approach is very, very pervasive throughout every aspect of the operation. It's not just the KYC, it's not just the transaction monitoring for AML, it's pervasive throughout, because there is an understanding that in order to sell services, financial service and inclusion, you're going to have to be a bit more flexible on that. So I think we as vendors, we as companies, we as financial providers, service providers, we have to have that conversation with regulators and to say there is a section that you have to assume to a certain level that they're going to be okay, and you can do your best. But at the end of the day, again, I think you have to look at it from the perspective that most users are going to be good users.
Well, the growth in AML and broader compliance for formally regulated institutions is well known. And yet the dialogue in the last 5-10 years is now in more non-bank sectors. How do we not only provide for those same regulatory oversight mechanisms, and then how do we enforce for them? So as more non-banks come online, as more fintechs come to provide service, do any of you fear that the regulatory burden will come squarely on you, right? Because as more of the mechanics of underlying banking happens outside of a bank, then that at least assumes a certain degree of responsibility on those vendors, providers, et cetera, right? And I like to remind folks, maybe somewhat tongue-in-cheek, going back into the regulators or the Treasury Department, when was the last time you guys went and audited Walmart? And they said, why? Like, well, Walmart's a frickin' bank, right? When was the last time you regulated Amazon? Amazon's a bank, right? These are all institutions that are providing financial intermediation. So how do you look at the space? I'm going to start with you, Shailee, because you're providing services to an otherwise understood, rightly or wrongly, as high compliance risk, if not high credit risk or other risk.
Yeah. So right now, I'm going to stick with that regulation sits with our partners, and we are just providing them the solution. I think eventually it'll come down on us, but as a startup right now, we are going to take their guidance and obviously comply with the regulations to our best ability, but we're really just a pass-through of their solution. I mean, we are not set up to take on the compliance burden we might in the future. But I think that's why banks are so well placed in this increasing level. I mean, I know it's expensive for them to do this, but they also have this as a competitive advantage over the fintechs, right? Many of us don't have that compliance background or the army of people to focus on that. So I don't know if that made sense.
Yeah, I'm going to add on to that as well. Also being a startup and not having kind of the army or just the technical capabilities of implementing those compliance systems. A lot of our bank aggregators or APIs or payment processors and our actual just profile carriers, they're the ones that are getting hit with the compliance. But that's currently. What you see is, particularly in the fintech space, banks are, no offense to any of you guys that are bankers, but banks are kind of slow to move, slow to innovate. And again, that comes with the regulation and risk and compliance. But what happens is a lot of times they'll go with white labeling solutions. And so because that's becoming more widely adopted as a habit and kind of the industry standard, I can imagine that they're going to start regulating on that base level where, the fintech startups that are handling it.
Well, I have what do you call it? I don't know, a position that is a little bit different in the sense that, I draw so my background I came from the computer security world and in the application world. And there's always the issue when you have vulnerability like we had last week, right, with Windows, right, to say who's liable, right? Is it the software vendor that is liable or is it not, right? And so I think that we as the fabric of whatever is the enablement of financial services, we have responsibilities. We as vendors, you as a service provider, we all have responsibilities in making sure that there is integrity in the market, that you are not servicing somebody that is financing terrorism or human trafficking. And these things are very, very real. I mean, this is not BS. This is real stuff. We have seen how money flows through the financial system to do money laundering, and the money laundering that ends up financing drug cartels or financing terrorism. So we all have a responsibility to play, and the trick is obviously try to understand from the regulatory perspective where is that balance, right? Where do you put yourself to help the system without burdening to the point of starvation, right? So you have to be able to innovate, you have to be able to offer new services. But at the same time, we as part of that infrastructure, we are responsible as well. We have our level of responsibility. In trying to push that responsibility back and forth, I think we are doing a disservice to the market as a whole. Because I think, as I said, if we all have sort of parts to play in this thing and we play our part, I think it makes it a bit better, as a better market. Is that easy? No, of course not, because it's trying to understand where the cost goes, right? Because that's one of the big problems. Who pays for all of this, right?
That's very good. I want to leave time for questions as well. You'll notice there are mics on either side of these of the rows here. So for folks that want to jump up and queue up for some questions, I'm going to leave it off with one question to each of you, and feel free to elaborate as much or as little as you'd like. Mr. Snowden yesterday morning said that KYC has not done, I think his word was bupkis, to fighting or combating money laundering or terrorism finance. Agree, disagree, and why?
So I agree or disagree. So I think what happens is that their understanding of the KYC definition is probably not right. So most people understand KYC as validating a name to an address to a phone to something. And that is what pragmatically some of the market has adopted as KYC. But KYC really is trying to understand, you need to understand who your customer is. And that is not just validating that your social security number matches your address, your name, and so forth. That's just one portion of it. Of course you have to do that because you have to try to understand whether you're dealing with a real person or not. But all that information, you can go almost any site on the dark web and find 60% of the population of the United States data is there. So it's very easy to buy that information. So our understanding or the implementation of our understanding of KYC has to be much more comprehensive than that. And there is technology out there that can help you understand and try to answer more fundamental questions about it. So do I agree that KYC, the way that we implement it, is not as effective? Yes, I do agree with that. But I think if we implement KYC from the perspective of what is intended to be, and we spend the time in making an effort to do that in the right way, I think it could be very valuable.
Yeah, I think I completely agree. I think that's exactly the case, which is today as it's implemented, most financial institutions are probably checking one form of data, two forms of data maybe, but we're seeing just the beginning. I think most of us probably in this audience are super used to signing up for things online, which is not how the vast majority of the world access financial services today. So we're a little bit of a self-selecting group, but we're used to the idea of two-factor authentication. Even challenge questions is sort of like, what street did you grow up on? Those things are still, they're actually not very effective, but just in general, these are not used by the vast majority of financial services providers today. So I think we're just seeing the beginning of what's possible probably in having a more effective solution. But as it stands today, I think that's totally right. You check one database and you're on. It's not particularly effective. You can buy my information online for sure.
Yeah, and I'm going to take a very similar position to that as well, just because of the ease it is from people, again, like you said, on the dark net or black markets to get access to this data and just sell it in masses. Yeah.
So I will say, to Snowden's other point on privacy and security sort of going hand in hand, we at BanQu believe in privacy for our end users and permission-based, that they should have the permission over their own data, and they should own their own data and give access to others to use pieces of that data. So that's very, very important. And I do think that privacy, is an issue. We see how the U.S., we don't own any of our own data in the United States. It's like every time you hit like on Facebook, they're picking up ambient noise. So something's got to change. And I think KYC is a very small piece of this entire equation. And it's unraveling every day. So. we'll see what happens.
Any questions from the audience? If not, I'm going to ask one final question. As you look at the future of your business and the future of, at least in financial services, as we look at risk management and compliance management, what's the biggest challenge you think you are facing in the next 2 years, next 3 years?
That's a difficult question. So what is our biggest challenge? I think in trying to capture, so let me tell you one quick thing about my views of identities, because I think this is relevant in the sense that my belief is that you don't need to capture somebody's data to understand how to use that data, right? And I think you can keep data in private ways, in transformed ways that allows you to offer services without the need to disclose the data. So what is that relevant to this question is because to me that is the thing that I look almost on a daily basis, is how do I take certain types of data, transform it so I can better inform the KYC process, the compliance process, without having to break into the privacy of somebody or exposing ourselves as vendors that somebody can go and hack into our database and expose the records of the hundreds of millions of users that we have in our databases, right? So how do we actually get data, transform it in a way that is useful without having to expose anybody's privacy? I think that to me is probably one of our most difficult challenges as a vendor.
Ours is, I think, is getting financial institutions to be open to using APIs in the cloud. I think if you want a good customer experience, good user experience, you want real-time data, you want data that's live and out there and that's not 3 years old in a stale database, you have to use cloud services, you have to use APIs, and I think banks are a lot, there's movement, a lot of banks are starting to use them, but it's the tip of the iceberg. I think a lot of banks are unwilling to do that because of data security, totally legitimate reasons, but that's going to be, to me, is a sort of barrier for us and barrier for financial innovation.
Yeah, one of the biggest things is going to be, as a consumer-facing product, is going to be that user experience. And so one of the biggest things for us personally, focusing on, millennial credit establishment, is just the personal feel that comes with it. So, the initial sign-up process, you're creating this unique financial profile that will dictate your user experience on the application. So again, with that data, keeping up with regulations and making sure that all of our data is safe and protected for each user.
So for us, in the near to midterm, it's going to be survival as a business, convincing people that to use the distributed ledger, try it out. We'll do a pilot with you if anyone's interested. And our open API, we have an API using it. But in the long term, I think it's once we actually, if we realize the vision of our, that people own their own data and they can give permission to others to use it, flipping sort of the whole economic paradigm to a demand-based economy rather than supply-driven data and transactions. And that to me is huge, and hopefully it'll get there.
Well, thank you all for your insights and appreciate the audience for joining this panel. Thanks.
Thank you.